Alright, folks, it's Wednesday after the close. It's still earnings season, and today we have an emerger reporting their very first profit. But before we get into that, let's just look at our top 10s for Q3 2024 so far. Alright, let's see what we've got here. Okay, so top 10 losses for 2024 reported so far. Annual. We still have Walgreen Boots in the lead, followed by Catalent, Peloton, Lumentum. Same old guys. Okay. Who do we have for top 10 highest earners reported for the year 2024 so far? Apple, Microsoft, Amazon, Procter & Gamble, Cisco. Qualcomm, they're new for my report so far. Lam Research, they're almost off the books. I bought into them last week. Top losers for Q3 2024 so far. Intel continues to take the cake with negative $17 billion, followed by Boeing at negative $6 billion, followed by Mobileye, Sirius, Willis Towers, Liberty, Xerox. Xerox, that's a new one that's appeared here. Interesting. Constellation Brands. Alright, top 10 earners for Q3 2024 so far. Alphabet, 26 billion. Berkshire, 26 billion. Microsoft, 25 billion. Meta and Amazon, 16 and 15 billion. JP Morgan, 13 billion. ExxonMobil, 8.5 billion. Bank of America, BOA, 7 billion bucks. United Health Group, 6 billion bucks. Wells Fargo, 5 billion bucks. Okay, folks, so let's get into our emerger. Who's the culprit? It's a company called Waystar Holdings. Now this chart that you can see right here, this is this is their listings history. Like, it starts in June. This is June right here. So they really only have a few months trading. It says on Yahoo that they were founded in 2017. So far that makes sense. We look at their financials. This is the annual still. Let's zoom this out a little bit for all you folks out there. Maybe we'll give it one more. There you go. There you go. So you can see the incrementing revenue. You can see kind of like steady losses. What do we have for cash flow on an annual basis? You can see positive free cash flows. You can see a dip recently. What's that attributed to? Purchases. So they did have a few large purchases in these 2 years. What did they have for this? Nothing jumps out at me, and I'm not going to be spending too much time here looking at it. But let's take a look at the quarterly stuff. Again, you can see, somewhat steady revenues. They had an anomalous good year about a year ago, quarter about a year ago. Their free cash flow, again, it's positive. It's not steady, but it's positive. So let's just see, what did they actually report in the current period. Okay, let's see what they said in their news release, in their 8K. Okay, so revenue growth of 22% year over year, net income of 5.4 million bucks. So how does that compare? So their last net income was negative 30 million. Before that, it was negative 16 million. Before that, negative 10 million. Okay. So today, they reported a Q3 2024 of positive $5 million. So that's about $35 million above their last reported loss of $27.5 million. Okay. Now their margin is 2%. That's pretty thin. This isn't bad. Okay, so all this stuff is great. It's all great. Let's look at something a little bit more detailed. Let's look at their actual 10Q financial statements, because unlike many companies, these guys reported them pretty close to the same time. Sometimes companies will leave like a few weeks between their 8K and their 10Q. So yeah, there's that 240 million bucks. You know, it looks like 22% to me. You know, we've got growth for the 9 months too. Their net income, again, you can see the $5.5 million that they've reported, up from negative 15 million the year before. So it's a $20 million difference. If you start looking at some of their things here, like what's accounting for this? What's accounting for the $30 million difference here? Right? Because this is very near to the same. And I'll tell you what it is. It's interest expense, I think. And it doesn't show up here, but I'll show you what I mean. Anyways, we've got 3 cents. We've got massive share count inflation. So let's just look at their balance sheet really quick. Now, if we look at their long-term debt, they've almost cut it in half. Like they've dropped their long-term debt by $1 billion. So let's just do some quick calculations. 1 billion times, I don't know, I wonder what kind of rates these guys are getting. Do they have a 10K out? I don't know, they don't have a 10K out yet. Let's just see what their 10Q says. Let's just see if they have anything written on here. Sometimes companies will report their debt on their filings here, but I think that's usually the annual ones. Let's see if we can get some clues here. Yeah, okay, come on, let's go, come on. Receivables facility 2%. Yeah, no, that's not that. Okay, receive a 6%. Okay. Credit facility 7.5. Million 7. Okay, so let's make a pretty big assumption here and go with 7% cost of debt, cost of capital. Actually, let's just see if there's something cost of capital. Oh, okay, there's nothing. Whack. No, nothing like that. Okay, so back to here. So if we've got $1 billion that they've lost in debt, that they've paid off from their debt year over year at 7%, now divide that by 4, because we're just looking at 1 quarter. That's $17.5 million, right? And so if we go back to the operations, we're looking to reconcile 30 million bucks. And just with that loss of that paying off of that debt, we can reconcile 20 million bucks. So it seems to me, without really diving too deep here, that by paying off their debt, half of their debt, they were able to bump themselves into a class of profit without really having a huge increment in revenue or other operating kind of parameters. So that's just a little theory there, but that's positive. This is good. That means that based on their normal existing operations, all they had to do was tweak their equity parameters a little bit, and now they're profitable. Now they're on a trajectory to profit. So that's very interesting, folks. Let's just take a look at their balance sheet really quick, because you can see that they've increased their stockholder equity by $1 billion too, right? So they really did pay off that $1 billion. It's not like they just transferred a bunch of assets around and liabilities, like they paid it off. So this company's painting an interesting picture. Now let's just take a really quick look at what their cash flows actually look like. Is it this one? No, it's not that one. This is the dev. And I need the prod. Okay, so what do we have? This one. Is it this one? No. Oh, that's the annual. Right. There we go. So obviously there's not a whole lot to see here, folks. Let's just fill in some gaps really quick. Which ones are we looking for? Q4. Do we have them? Q4 and Q1 2024. Okay, so we've got Q1. So that's 224792. Okay. And now we'll take the annual here. No, but we don't have that one. Okay, so that's fine. We'll still graph this out really quick, just to get an idea of what that might look like. So you can kind of imagine, that there might have been a value halfway here. And then boom, there's the zero line. I don't know if you guys can see this too good. There you go. I know this isn't a pretty chart and we're missing the value here. But you can see what the general trajectory is there. Let's see if I can get a revenue chart here. Do I have them for revenues? Don't convert. No, they don't report revenue in a way that I capture. Okay, so there you have it, folks. Waystar. Good for you, Waystar, reporting your first ever profit of $5 million. Now, for anybody that's curious, they currently have a market cap of $5 billion. So let's annualize that 5 million to 20 million, and let's just see what that PE looks like. 245, folks. So that's pretty aggressive, but I mean, hey, it's too early to really establish their earnings growth trajectory because we have such limited info. Anyways, I hope you guys found this useful. You know what to do if you did. Take care. Thanks for tuning in.